Hi everyone, welcome to the online class Kilora. I'm Lavanya. So, last class we have understood the types of reports and advantages and disadvantages of Tally and each and everything. So, in this class, we are going to understand how to generate the financial report in Tally. So, as I told you, this Tally is a popular accounting software that provides a various financial report to help the business manage the financial operations effectively. So here are the some financial reports as I told you before itself. A balance sheet which helps you to a snapshot of a company financial position, and profit and loss account which shows the company revenue and expenses and net profit and loss also, and cash flow statement which shows the flow inflow and outflow of the cash and cash equivalents, and the trial balance which lists all the general ledger accounts and the corresponding debit and credit balance, and ledger account which detailed report showing all the transactions and balances for a specific ledger account, and a account statement which helps in showing all the transactions and balances of the specific accounts or a group of accounts, and inventory reports. This report shows stock level, stock value, and movement of inventory, and sales and purchase report helps you to show the purchase and sales transaction, and the day book, it allows you to record all the transactions in a journal ledger over a specific period. Outstanding report is a report which shows outstanding invoice, bills and payments, and also budget and variation report helps you to compare the actual financial performance with the budgeting amount. Ratio analysis report helps you to show the financial ratios such as debt to equity, current ratio, and return on investment. And the last report is audit report. This report provides a detailed information of auditing purpose. So these are the few financial reports which helps you to generate in Tally. So let's understand how to generate this financial report in Tally. We have to follow few steps. The first one is open a Tally and select the company for which you want to generate the report. The first step you're gonna do is open the Tally and select the company for which you want to generate the report. And then you have to create a gateway of Tally and display the statement of accounts. And the next is you have to select the report you want to generate. For example, balance sheet, profit and loss statement, or cash flow statement, anything. So you have to select the report which you want to generate. And the next is you have to choose the reporting period like monthly, quarterly, or yearly. And then you have to select the format, for example, detailed, graphical, condemned, all this. And then next you have to click the accept to generate the report and use the export option to save the report in various formats like PDF or Excel or SLV, etc., whatever it is. This is how you generate the financial report in Tally. So here are the some specific generation steps. The first one is balance sheet. Here the balance sheet is a balance sheet steps are like, first you have to go to the gateway of Tally, display statement of account, and then you have to select the balance sheet. When you want a profit and loss account statement, you have to go to the gateway of Tally, display, click on a statement of accounts, and select the profit and loss account. If you want cash flow statement, you need to go to the gateway of Tally and then display and statement of accounts, and then click on cash flow statement. If you want a trial balance, you have to go to the gateway of Tally, display the, and then select the statement of accounts and click on a trial balance. If you need a ledger account, you have to same go to the gateway of Tally, display, and then accounts book, and then you have to click on a ledger. So these are the few steps which may depend on the Tally version and configurations. You have to note and identify it. And also you can use this report or a menu and press Alt plus R to access the report generation window directly. So this is very important to ensure that your data is up to date and accurate before generating the financial report in Tally. So the next topic is statement of accounts. What do you mean by the statement of accounts? In Tally, generating this statement of account typically refers to create a report that provides a summary of all the transactions which is related to a particular accounts or a group of accounts over a specific period. So this in Tally, the statement of account refers to the comprehensive financial report that displays a detailed breakdown of a company financial transaction and position. So this includes various financial statements and reports that provides insight into a company financial performance and position. As I told you in a past class itself, the statement of accounts in Tally, which includes nothing but balance sheet, profit and loss account, cash flow statement, trial balance, ledger account, account statement, outstanding reports, and budget and variance reports, all this. So these reports provides a snapshot of a company financial situations and helping users to analyze the financial performance, identify the trends and patterns, make a better informed decision, and prepare a tax return and statutory report. And also it helps the users to conduct the audit and financial review also. So the statement of account in Tally is a centralized hub of accessing and reviewing the company financial report and statement. Now this is also the same way how you generate um, how do you generate this financial report in Tally? The same steps will be followed in generating the statement of account in Tally also. The first step is open the Tally and select the company for which you want to generate this report. And the second step is gateway of Tally. You have to go and click on a display and select the statement of accounts. And the third step is select the reporting period like monthly, quarterly, or yearly, and then you have to choose the format which you need to be done. It should be in a graphical format or a detailed format, and then you have to select the accounts or a group of accounts to include in the report, and then you have to click accept to generate the report, and finally use the export option to save the report in various formats like PDF, Excel, CSV, anything. The next one is ratio analysis. What do you mean by this ratio analysis? Ratio analysis is a technique which is used to evaluate the company financial performance and position by calculating and analyzing the various financial ratios. So this ratios provides insight into different aspects of a company financial situations such as liquidity ratio, profitability ratio, efficiency ratio, solvency ratio, cash flow ratio. This liquidity ratio is the ability to pay a short-term debts. For example, current ratio and a quick ratio. When it comes to the profitability ratio, ability to generate the earnings, for example, gross profit margin, return on equity, And the third one is efficiency report. Your effectiveness used of resources, for example, assets turnover, inventory turnover. And the next report is solvency ratio analysis. Here, this ability to meet long-term obligations like debt to equity ratio, interest coverage ratio, etc. And the next one is financial cash flow ratio. Here, the ability to generate the cash, for example, cash flow margin, cash conversion cycle, etc. These are the few ratios which provides insight into a different aspect of the company financial situations. So, how this ratio analysis helps the user? This ratio analysis helps the user to identify the trends and patterns and compare the performance with individual averages and competitors. Making informed decision is also one of the users' help, and evaluating the management performance, forecasting the future financial performance, or ratio analysis helps the users in these 5 ways. Yeah, the few common financial ratios like current ratio, which includes current asset divided by current liability, return on investment, which is calculated through a net profit by shareholder equity, debt to equity ratio, which is calculated total liability divided by shareholder equity, gross profit margin is calculated with the help of gross profit divided by sales. Asset turnover is calculated through sales divided by total asset. These are the common financial ratios. By calculating and analyzing these ratios, user can gain a deeper understanding of a company financial health and make more informed decisions. So, let's understand one by one common used financial ratios. The first one is liquidity ratio. This liquidity ratios, which means ratios which measures a company ability to meet its short-term financial obligations, and they indicate whether a company has sufficient liquid asset to meet its short-term obligations. So, for example, which includes current ratio and a quick ratio. How this current ratio is calculated, and let's understand with the help of the examples. The formula which is used for the current ratio is current asset divided by current liability. So here the current assets will be given and the current liabilities will be given. We have to divide this both. We'll get a current ratio. For example, company XYZ has a current ac- asset for 1 lakh and a current liability for 50,000. So we have to divide 1 lakh divided by 50,000 and we'll get 2. So that 2 is the current ratio for the company XYZ in a current liability. So the next one is quick ratio. Quick ratio formula is current asset minus inventory divided by current liability. So quick ratio is also called as asset test ratio. Here let's have an example. A company ABC company has a current asset of 80,000 which includes 20,000 in inventory. So we have to minus this 80,000 minus 20,000 will get 60,000 and the current liability is 40,000. So 60,000 divided by 40,000 is 4.5 ratio. So this is how you calculate this liquid ratio with which includes current ratio and quick ratio. So these companies, ABC has 1.50 in a quick asset, which includes inventory, for every $1 in current liability. So the highest liquid ratio indicates a company ability to meet the short-term obligations, while a lower ratio may indicate the liquidity issues. Liquidity ratios are important because they help evaluating the company ability to pay its debt and assess its financial flexibility and identifies the potential cash flow problems and makes informed decision but lending or investing is done. So these ratios are very important, which depends on the industries and the company sizes and other factors also. So this is one of the common used financial ratio. The next one is profitability ratio. This profitability ratio is a ratio which evaluates the company ability to generate the profit relative to its revenue, asset or equity. So this profitability ratio is a financial metric that assesses a company capability to provide income in relation to its revenue, operating expenses, balance sheet asset, or shareholder equity over time. This ratio can be grouped into two categories. One is margin ratio, the another one is return ratio, gross profit margin, operating profit margin, net profit margin, cash flow margin, return on asset, return on equity. All these are examples which includes in profitability ratio. Margin ratio is a ratio which represents a company capacity to convert the sales into profit at a very various levels of measurement. Return ratio is the ratio which represents the company capability to produce return for its stakeholder. Some of the common examples for profitability ratio includes gross profit margin, which means this ratio compares gross profit to the sales income. And the next one is operating profit margin. This ratio examines the profit as a percentage of sale before subtracting interest expenses and income tax. Net profit margin. This ratio examines the company net profit and drives it by total revenue. And the next one is cash flow margin. Here this ratio expenses the connection between the cash flow from operating activity and a sales created by a company. Return on asset is this ratio shows the percentage of net earnings in relation to the company overall assets. Return on equity, this ratio expenses the percentage of net income or increase or in relation to a stockholder equity. So this is also one of the ratio which is used for the users, that is profitability ratio. The next ratio is efficiency ratio. Here this ratio assesses how effectively a company utilizes its asset to generate the sales or profit. Here this ratio is a measure of company well a company uses its assets and liability to generate the sales and maximize the profit. There are few following examples for the essential ratios. The first one is inventory turnover ratio. This ratio is experienced as the number of times as enterprises sells out of its stock of goods within a given period of time. When it comes to allocates resources, turnover ratio. This ratio evaluates the efficiency of revenue collected. This measures the number of times a company collects its revenue average account receives over a given period. So, for example, inventory turnover, accounts receivable turnover, and asset turnover ratio are the examples for the financial ratio. The next ratio is solvency ratio. Here, what do you mean by the solvency ratio? It's a ratio where a financial metrics that measures a company capacity to meet its long-term obligations. So, here are a few points which solvency ratio is used while calculating. Types of solvency ratios are debt to equity, debt to asset ratio. Debt to equity D bar E ratio compares a company total debt amount balance to the total shareholder equity account, showing the percentage of financial contribution by creditors versus equity investors. And the next one is debt to asset ratio. By comparing the company tool debt burden to the value of the total asset, debt burden to the value of its total asset, the equity ratio measures the value of a company equity to its assets amount. How do you calculate this solvency ratio? Solvency ratio formula is net income plus depreciation, which is divided by all liability bracket open short term minus long term liability. So, for example, a sales smart company net worth is 45,000, depreciation is 50,000, short term liability is 83,000, long term liabilities 1,60,000. Solvency ratio is 45,000 plus 50,000 divided by 83,000 plus 1,60,000 is equal to 0.246. That is, in a percentage, it is 24.6 percentage. The one of the disadvantage of solvency ratio is it does not fact in a company capability to acquire a new funding source in a long term, such as funds from stocks or bonds. And the next ratio is market value ratio. What do you mean by this market value ratio? This ratio measures the market perception of a company performance and the value. So, this financial metric that assesses a company's stock price in relation to its earning. So, book value or other fundamental metrics. This ratio helps investors and analyze the evaluate the market perception of a company's performance and potentials. So here are the few common market value metrics or ratios with an example. The first one is price to earning ratio, price to book ratio, price to sales ratio, dividend yield. The first one is price to earn ratio. Here you have to compare the stock price to earn per share. For example, company XYZ stock price is $50 and its earning per share is EPS is $5. Here, with the help of this P by price to earning ratio is equals to $5,000 divided by $5 is equals to 10. And the next one is price to book ratio. Your price to book ratio is your price to book ratio compares the stock price to the book value per share. For example, if the company ABC stock price is $40 and its book value per share is $20, so the ratio will be calculated for the price to book ratio is $40 divided by $20 is 2. So the next ratio is dividend yield. Calculates the ratio of annual dividend per share to the stock price. For example, a company ABC annual dividend per share is $2 and its stock price is $5.50. Here the dividend yield is equals to $2 divided by $50 into 100 is equals to 4%. This is how you calculate the dividend yield. And the next ratio is price to sales ratio. Here you'll compare the stock price to revenue per share. So let's have an example. A company ABC stock price is $30 and its revenue per share is $15. So price to sales ratio is equals to $30 divided by 15 is 2. So these are the ratios which helps investors and analytics evaluate the market perception of a company performance and potential and make informed investment decisions. So these are the common ratios which are used in Tally and the uses. And finally, the ratio analysis in Tally refers to the calculating and analyzing of various financial ratio within a Tally accounting software. Tally provides a built-in feature to calculate and display the various financial ratios such as liquidity ratio, profitability ratio, efficiency ratio, solvency ratio, market value ratio. Liquidity ratio, let's have an example. Current ratio, quick ratio. Profitability ratio includes gross profit margin, net profit margin. And the third one is efficiency ratio. It includes inventory turnover, asset turnover. And the fourth one is solvency ratio. For example, debt to equity ratio, interest coverage ratio. And the final one is market value ratio, which includes price to earning ratio and price to book ratio, price to sales ratio, and dividend yield ratio. All this comes under market value ratio. So these ratios are calculated based on the financial data entering in Tally, such as balance sheet, profit and loss account, or any other things. So now you understood the types of ratio analysis in Tally, and also you have to mainly understand how to access the ratio analysis in Tally with the steps. The first one is you have to open the Tally and select the company for which you want to perform the ratio analysis, and then you have to click on a gateway of Tally and select display and choose the ratio analysis and open it. After selecting a type of ratio you want to calculate, like liquid, profitability, efficiency, solvency, market value, any type of ratio, you have to choose the reporting period like monthly, quarterly, yearly, etc. And then finally you have to accept and generate, click on accept and generate the ratio analysis report. So these are the very important steps which depends on a Tally versions and configurations, and how this is how you access the ratio analysis in Tally with the help of. So these are the ratios are calculated based on the financial data and enter into the Tally, such as balance sheet, profit and loss, any other account data. So with the help of this, various types of ratios are then displayed in the report format and allows the users to analyze and interpret the result. So this Tally provides a built-in feature to calculate and display the various financial resources. So this is how you access the ratio analysis in Tally. Thank you.